Hi, I'm Wayne Zell. I'm an estate planning and business planning attorney. I'm discussing the basics of business planning, and now I'd like to talk about the advantages and disadvantages of limited liability companies and S corporations. Let's talk about LLC advantages first. LLCs are easy to form. You only have to file articles of organization or a certificate of formation, which may only be a very short one-page document. They're also flexible. You can structure it so that the members, who are the owners, are the managers of the entity. For tax purposes, LLCs generally default to the flow-through of profits and losses to its owners. Now, you have the ability with an LLC, because it's so flexible, to elect to be treated as a subchapter S corporation for tax purposes. You can also elect to have an LLC be treated as a regular C corporation. This is accomplished by checking a box on a particular IRS form. There is a possibility that a limited liability company with 100 or more members may be treated as a publicly traded partnership. In that case, it's treated and taxed like a corporation. The LLC provides limited liability to its members, meaning that the members are only liable for their capital contributions and any assets that are already in the entity. So it's good creditor protection, meaning that a creditor of an LLC in most states can only get a charging order. Charging orders generally allow the debtor, you as the member, to retain control over the LLC and determine the timing of any distributions in the future. There are some exceptions to that general rule, particularly when there's fraud or if there's bankruptcy. Anyone can own an interest in an LLC, as long as the LLC does not elect to be taxed as an S corporation, which has restrictions on who can own it. So that means that non-resident aliens and trusts of all kinds and estates and even more than 100 owners can own interests in an LLC. The owners of the LLC can claim losses for losses that are generated by the LLC, not only for money that they've put in to fund those losses, but also for any borrowing that was incurred by the entity. While LLCs also have certain disadvantages, one being that they're new to the world of business entities. The oldest LLCs in our country are only about 22 to 23 years old, and most statutes that have enacted LLCs are only 14 or 15 years old. So there's an undeveloped case law history. Also, every state has its own statute. That could lead to anomalous results. Another disadvantage is that members are technically not allowed to be employees for federal income tax purposes. Therefore, they do not receive W-2s, and the entity cannot pay their Social Security and Medicare withholdings. Unless it's treated as a corporation, an LLC cannot merge tax-free with another entity, whether it's a corporation or an LLC. And employees are not allowed to receive incentive stock options that have tax-favored treatment under federal tax law. Taxable income is treated as subject to self-employment tax automatically. S corporations, on the other hand, have several advantages. An LLC or a regular corporation can elect to be treated as an S corporation if the statutory requirements are met. An S corporation has limited liability, just like an LLC, and because the corporate law is better developed in all 50 states in the District of Columbia, it may be better to have a corporation elect to be treated as an S corporation. S corporations generally allow income, gain, loss, and credits to flow through to the shareholders, just like in a partnership. Unless it was previously a regular corporation that has double taxation, the S corporation can sell the business or the assets and incur generally only one level of tax. The type of tax is going to be ordinary income or capital gain. That will depend on the structure of the sale or merger and acquisition transaction and the type of assets and the business conducted by the S corporation. With an S corporation, you can merge it tax-free with another corporation, either an S corporation or a regular corporation. If many employees are generating profit for the company and you only have a couple or a few owners, then the owners may be able to extract the earnings without paying self-employment tax. This makes an S corporation in some ways more favorable than an LLC. Now, here are some disadvantages of operating as an S corporation. First, you can only have 100 shareholders and no more in an S corporation. Second, certain persons are not allowed to be shareholders in an S corporation. Only certain types of trusts are permitted. Estates of decedents are only allowed to be shareholders in an S corporation for 2 years following the death of the owner. And no non-resident aliens are permitted to own stock of an S corporation. If you extract and want to distribute appreciated assets to the shareholders, you would have to pay a corporate tax of 35% or more on the distribution. Another disadvantage, you're only allowed to have one class of stock in an S corporation. But what most people forget is that you can also have voting and non-voting stock of the same class. Another disadvantage is that the losses for the shareholders cannot be deducted in excess of their basis in their shares. Basis can only be generated if you put in cash into the company or contribute property to the company and make certain types of loans directly to the company. But if the company borrows money, it doesn't generate tax basis, even if you as the shareholder are required to guarantee the debt. An S corporation requires all shareholders to approve of the election. And only one shareholder can inadvertently cause an S corporation to lose the S corporation status if, for example, they transfer their interest to an impermissible trust. Up next, I'm going to discuss non-compete agreements.